When people think about investing, one of the first things that comes to mind is buying a house. We've all heard phrases like, real estate never goes down. They're not making more land. The safest investment is property. For many people, owning real estate feels like the ultimate financial goal. But is it really the best investment? Or is that just one of the biggest financial myths? In today's video, we'll explore how real estate investing actually works, its advantages, its risks, and whether it's the right investment for you. Let's begin. What is real estate investing? Real estate investing simply means putting money into property with the expectation that it will generate a return in the future. Unlike stocks or bonds, you're investing in a physical asset. There are several ways people make money from real estate. The first is through rental income. You buy a property, rent it out, and receive monthly payments from tenants. The second is capital appreciation. If property prices increase over time, your investment becomes more valuable. Many investors benefit from both. They earn rental income while waiting for the property's value to grow. On paper, it sounds simple, but reality is often much more complicated. Why do people like real estate? There are several reasons why real estate has become one of the world's most popular investments. First, it's tangible. Unlike stocks, you can actually see your investment. You can visit it, improve it, repair it, or even live in it. That makes many people feel more comfortable. Second, property prices have generally increased over long periods in many countries. Not every year, not every decade, but over many decades. Many housing markets have grown considerably. Third, rental income can provide relatively stable cash flow. Instead of depending only on price appreciation, investors may receive monthly income from tenants. Finally, real estate often allows investors to use leverage. This simply means borrowing money through a mortgage. Instead of paying the full purchase price yourself, the bank finances part of it. If everything goes well, your investment grows while using someone else's money. This can increase returns, but it also increases risk. The hidden costs. One of the biggest mistakes beginners make is focusing only on the purchase. Buying a property involves many additional expenses. There are taxes, legal fees, insurance, maintenance, repairs, property management, vacancy, periods when nobody is paying rent, unexpected emergencies, a broken roof, a leaking pipe, a new heating system, or these costs reduce your actual profit. Real estate is far from passive. Even if you hire a property manager, someone still has to solve problems, and those services cost money. The risks. Like every investment, real estate carries risk. Property prices can fall. This has happened many times throughout history. The 2008 financial crisis is one famous example. Millions of homeowners around the world saw property values collapse. Investors owed more money to the bank than their homes were worth. Interest rates also matter. When mortgage rates rise, monthly payments become more expensive. That usually reduces demand for housing, and lower demand can put pressure on prices. Liquidity is another important factor. If you own shares of an ETF, you can usually sell them within seconds. Selling a house can take weeks, sometimes months, sometimes even longer. Real estate is considered an illiquid investment. Real estate versus stocks. The answer depends on your goals. Real estate offers physical ownership and can generate rental income. Stocks offer diversification, liquidity, and usually require much less capital. Buying a property might require tens or hundreds of thousands of dollars. Investing in an ETF may only require a few dollars. Stocks are easier to buy, easier to sell, and much easier to diversify. With one global index fund, you can own tiny pieces of thousands of companies around the world, buying one apartment means all your investment depends on a single property in a single location. Neither investment is automatically better. They simply have different characteristics. Ways to invest in real estate. Many people think the only way to invest in property is buying a house, but today there are other options. One popular alternative is the real estate investment trust. A real estate investment trust are companies that own and manage real estate. When you buy shares of a real estate investment trust, you're investing in a portfolio of properties instead of buying one yourself. Shopping centers. Office apartment complexes. REITs often provide regular dividends and can be bought just like stocks. For beginners who want exposure to real estate without managing tenants or mortgages, they can be an interesting option. Is real estate right for you? Real estate can be an excellent investment, but it's not a guaranteed path to wealth. It requires capital, planning, patience, and understanding the risks involved. For some people, owning rental property fits perfectly with their goals. For others, low-cost index funds may be a simpler solution. The important thing is not choosing the investment everyone else is talking about. It's choosing the investment you actually understand. In conclusion, real estate has created wealth for millions of people, but it has also caused financial problems for many others. The difference usually isn't luck, it's knowledge. Understanding how property works, the costs involved, and the risks you take allows you to make better financial decisions. Because successful investing isn't about following trends, it's about understanding what you're investing in. If you enjoyed this video, subscribe to Financial Fix Blueprint. In the next episode, we'll explore another major asset class and continue building the financial knowledge that every investor should have. See you in the next video.